Hello, my name is Eddie Tofvik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Paris milling wheat. For another week, Paris milling wheat has some very different patterns, though we are seeing some similarity in the more recent actions when compared to Chicago, Kansas City and Minneapolis wheat. Here there has been one continuing dominant pattern, a quite large pattern that 3 weeks ago took a break on the downside. It is of course the dark blue highlighted late August 24 to late February 25 ascending triangle pattern. And this pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it, but it can be clearly seen on my daily chart. 4 weeks ago I laid out targets below for this pattern, and I quote, "The primary target X will be in the 226 zone, secondary hard to reach target X1 down in the 194 zone." End of quote. 3 weeks ago the market reached the primary target X, pushing down below it, though not at the time fully breaking the significant purple March 24 to date uptrend currently at 226. And the market in mid-March ended up pulling back up over the purple uptrend and running along the top of it, but capped late last week by the declining long moving average currently at 229. Now going back a bit, what really stopped the fall was the 50% absolute Fibonacci line at 219. This, apart from its obvious significance as a 50% absolute Fibonacci line, had importance because it helped hold up prices back in November and early December last year, and also eroded the bearish incentive back in August and September as well. I asked over the last 2 weeks, and I quote, "Will this bearish pressure be enough to see further moves lower, or will target X at 226 have been enough, and the stoic support below the 50% absolute Fibonacci line start the formation of a new pattern?" End of quote. Well, to help in my thinking, 3 weeks ago I amended the further targets below into target X1 being at 205 as a secondary harder to reach target, and target X2 being a tertiary target and even harder to reach target down at 194. The pullback higher over the last 3 weeks ahead of the overhead long moving average plus the medium moving average currently at 231 and the 50% Fibonacci line, the March to May 24 move also at 231, put me in mind of a possible bearish half hesitation in construction. However, as I said last week, and I quote, "The question still remains as to whether prices will take this time to form a possible bearish half hesitation, or will they recover further? The latter seems unlikely right now, and the former, well, it's too early to say, though it might comply with what's going on with other grain markets." End of quote. Comply? Well, the market did, as this week prices dropped down below the 50% absolute Fibonacci line at 231, including today a gapping move lower. One could look at this contract as being a leader for the other grain markets, as prices are now on, not for a possible double bottom, but also for a possible bearish half hesitation pattern, with a potential target X3 down in the 206 zone. Minneapolis wheat. 4 weeks ago, the market turned higher. It was turned by a combination of a previously mentioned congestion zone stretching from 585 to 610, dating between roughly mid-November last year to late January this year, with a key halting support being at 578, an approximate high area dating from June 2019. Now, even to me, this halt was a somewhat surprising action. The recovery since then had initially been up to the combination of the April 21 low at 606, the purple previously broken September 2019 today uptrend, currently also 606, and a dark blue, also previously broken July 23 to date downtrend, currently at 597. All these were at the time quite close together, and back then just underneath the moving averages. These moving averages together, the short moving average currently at 607, the short medium moving average currently at 615, and the medium moving average currently at 609, also formed a bow tie formation, much as we have seen in other markets. But unlike Chicago wheat, which has a similar pattern, the formation here is not so well defined, and it does share similarity to Chicago wheat in that the tines are not in the right order, and with a significant bearish tinge to it. Now, I made a deliberate choice not to highlight these moving averages over the last few weeks, including today, as doing so would further obscure what is a very busy narrow market juncture. So what you have to look out for is in between 15 to 20 sessions forward from the crossover, and I estimate the crossover to be the same as in for Chicago wheat, so look forward towards between the 4th to the 10th of April. Thus, watch out for one or more of the following: a change in trend, a reinforcement of an existing trend, and volatility. In recent days, what we've left behind ever since at least early January is a V-top pattern as part of a larger bump and run reversal top pattern. The primary target point for this move lower has already been reached in the 585 zone, as indeed the secondary hard to reach target at 581. The tertiary, much harder to reach, not target but potential down in the 549 zone, seen for a while to be too far considering the pullback we've seen. But as I said last week, and I quote, I asked myself again as I did last week, do I think this is still opportunity on the downside? Possibly, but I once again feel as I did at the end of my commentary some 4 weeks ago, so that's 5 weeks ago now, that, and I quote, we have a lot of congestion between 610 down to 585 dating from November last year to January this year, and that could erode any further bearish incentives. Now, that's the end of that quote. I carried on and I quote, I might be wrong on this as well, but as a consequence I've chosen to label these last 3 to 4 weeks as a V-bottom, but one that may be building up to a possible bearish halfway hesitation, end of quote. Now, I also thought back then that there might be a possible diamond pattern type, but the idea of a bearish halfway hesitation has become to me more attractive. It will all depend on what the market does on approach and at the key 578 level. Hence, I have not laid out any targets below for any bearish half hesitation. It is still too early for that right now, but I can indicate a potential, or say down in the 555 to 560 zone, which is not too far away from the low we saw back in August last year down at 563. If, on the other hand, the 578 level holds on up the market as it did before, then we have the opportunity of a possible double bottom. But it all depends on what happens at the 578 level, should we get there. Finally, I have drawn a new mid-February to mid-March bearish Andrews pitchfork, and the cute one to help show the bearish angle of attack. We are right now in between the overhead upper time, currently at 609, and the middle time below, currently at 559. Your London UK feed wheat. There continues to be here on this daily chart, even now, these many months, only one major significant pattern here, and that is the bright red late May, early July 2024 bearish shift pitchfork. The market has recently reasserted the dominance of this pattern, with prices breaching, then repairing an attempted break higher over the bright red upper time, currently at 178.25, back in late January and early February. Add to this the earlier this week narrow mix overhead of all the moving averages, earlier this year narrow mix overhead of all the moving averages, though they are now separating out, as well as the 50% absolute Fibonacci line at 180.5, and you had, and I suppose still have, a close together compacted area overhead that, as I have repeatedly said for months now, that had been brewing up for a significant move, which has seemingly happened, or even started to happen again, over late February and into March. It was, as I said 14 weeks ago, and ever since, and I quote, even now still looking for that better pattern to appear. Until that shows up, I will continue utilizing this bright red bearish pitchfork. End of quote. So my point is, the bright red bearish pitchfork has turned out once again to be the pattern I was looking for all the time. This leads me to my final 4 points, and 3 of them was something I had noted in my recent annual commentary on London feed wheat. Firstly, I saw there the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern, akin to a double top formed after a big fall, such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2020 to date very large head and shoulders pattern, head and shoulders top pattern. These super long-term patterns are still live, and they both rely on one feature, and that is their common neckline, highlighted in dark blue on my daily chart, currently at 167.55. For most of March, prices had been sliding down along the top of this support of these dark blue pair of necklines, However, last Friday the market closed below it, and more importantly closed with a weekly key reversal down below them. There is more on this, which I will discuss shortly. The third feature is a little more longer term. It is the March 2016 today recently finessed uptrend, highlighted in purple on my daily chart, and that's currently at 167.95. For the last few weeks we had the market pressing and reinforcing the dark blue necklines and the purple uptrend, but last Friday was the first close below both of them at the same time. We also have the May 2023 low at 168 even, which added support, however limited that may be, as it had been previously breached to these two necklines and the purple uptrend. But last Friday all these supports were overhead, not below, with the added bearish value of being seen off by a weekly key reversal down. Now, I have said repeatedly there was one major possible severe criticism of the two necklines, and that is that they then previously breached and should, some would argue, broken. However, I contend and counter with that by saying that I transpose these from my longer term monthly charts, and whilst on a daily and even on a weekly chart they may appear breached and broken, on the longer term monthly charts where they really live, they are still somewhat valid, and so I would not take these as cast iron lines in the sand that should not be crossed, but as longer term strategic patterns that we should bear in mind and occasionally bring a closer eye upon, such as now. It would be, as I said last week, and I quote, a monthly close for March in about a week and a bit below these would, I suspect, be a significant move. End of quote. Well, this week has been very, very interesting, as initially we had a gapping move higher at the start of the week, but then throughout all this week prices have eroded such that we are now at new lows today, ones not seen since late June last year. Plus, we are on the verge of making a rare compound weekly key reversal down this week. This is when we have a weekly key reversal down that is followed by a even larger weekly key reversal down. Thus, if tonight we see prices close under 166 3/4, then we'll be on. Anything between 166 3/4 and 168.90, and we'll have a lesser outside week, still a bearish pattern but not so much. Anything beyond 168.90 would have an immediate countering weekly key reversal up. At the moment we are looking at a compound weekly key reversal down here. Additionally, over the first 3 weeks of March we seem to have formed, unsurprisingly, a hesitation area, which when tied in with the mid-February start of March down leg gives us the possibility of quite a large bearish half hesitation. It is too early just yet to set a target below for such a pattern, but a potential would be down in the 155 even zone below. This is an idea worth closely watching. Finally, I've drawn a new mid-February, late March bearish Andrews pitch hook, an acute, narrow one, but still acute, to help show the bearish angle of attack. This is a very nascent pattern, but I think it might hold merit. We are currently in between the overhead upper time, currently at 168.70, and the middle time below, currently at 162.20. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.